Thank you, gentlemen. Good morning, good evening, and good afternoon, depending on your time zones. This is the eighth episode of Karandaz's podcast series that focuses on topics related to financial inclusion, digital finance, SME development, and economic growth in Pakistan. It features discussions with industry experts, policymakers, and thought leaders on the subject. And we are fortunate enough to have international guests for this round. We've in the past spoken about financial inclusion, SME growth and financing, digital payments and fintech, women's economic empowerment, investment in capital markets. The aim of the series is to provide insights into Pakistan's financial ecosystem, showcase success stories, and discuss policy and market based solutions for economic development. We will today discuss the role of credit guarantees in deepening financial markets and emerging economies. I will start by introducing our distinguished guests. We have with us Mr. Kamar Salim, who leads the world's foremost SME finance center, which fosters global knowledge and exchange. At IFC, he heads the SME Finance Hub. He previously led advisory service for financial institutional group in Asia Pacific and served as global SME and supply chain finance lead. He has over 30 years of experience in financial services across 80 plus countries, and he's advised 300 plus institutions and has held senior roles in IFC, HSBC, Standard Chartered, and Deutsche Bank. Our second guest is Ammar Habib Khan, who is the CEO of the newly formed National Credit Guarantee Company of Pakistan. Ammar has over 14 years of experience in risk management, energy, finance, and fintech. He's held leadership roles, including CEO of Credit Book Financial Services, and he was the group CRO of Karandaz Pakistan prior to this. He's a CFA and FRM who also advises energy sector reforms and writes bi-weekly for national publications. We have an international guest from Morocco, Mr. Abdul Mughith Abdul Momin. He is a CFA who works as a chief strategy officer at Morocco's Tamwilcom. He has experience that spans over 20 years in public and private sectors. Prior to joining Tamwilcom, he served as a senior manager at the strategy and financing consulting practices at Deloitte. He holds a master's degree in financial engineering, and in addition, he's a CFA and has expertise in financial modeling and valuations. So now I'd like to sort of set the stage and the context for which the discussion will take place today. And it's very interesting, and I would like to keep it at a high level before my guests bring in their expertise and very niche knowledge. So SMEs, is small and medium enterprises, are the backbone of any economy. Globally, they contribute 40% to the GDP of emerging economies, 50% to global employment, and represent about 90% of all businesses that are present. Despite the pivotal role, high interest rates and absence of collateral can hinder SME access to finance. IFC estimates that over 40% of micro, small, and medium enterprises in the developing countries face an annual financing gap of 5.2 trillion. Now, I dug this figure up from 2024, but Kamar has a recent study and a more updated number. Now, the global economy has been hit by a series of shocks. The most recent one being the 2020 COVID shocks that the financial sector around the world experienced, and SMEs were a big victim of those financial shocks. The shocks led to an unprecedented interest rates increase of 30%. Increase in interest rates, which is an increase of 2021. This resulted in a lower uptake and offer of SME loans. Applications dropped by 2 percentage points as interest rates went up, and new loans in these economies declined by 1.8%. I beg your pardon. Now, this was a bit of background of the global landscape or emerging economies, if you like. Kamar, I'd like to bring you in at this point very briefly. So I've gone over the importance of SMEs, how they form the backbone of the global economic structure and global economies. And there's a financing gap, I believe. And I understand that there has been a new study that has brought to light the gaping gap between demand and supply of SME financing. So, would you like to highlight that gap for us?
Such wonderful friends and colleagues. So let me highlight that, you mentioned the 40% contribution to GDP. Just picking off from what you mentioned, you'll be surprised to know that the SME finance that, that is being done now is actually less than 5% of the total. I just want to create that distortion, on the amount of, money we leave on the table in SME financing that is needed by the global SME landscape. So the new gap study that we recently revealed, you could find it on our website, puts the finance gap at $5.7 trillion. And I think when we compare it to the previous numbers, which, the last study when we had done was 4.4 trillion. So you can see that, how the finance gap has increased. Whereas if we see the same period, the supply increased from 3.7 trillion to 4.6 trillion. So the issue has been, it's not that the supply is not increasing. The issue is that the demand is outpacing the supply. And I think there needs to be a more energetic, efforts by the financial sector to enhance the SME finance. I also want to put a couple of other figures into the equation. I think one
Sorry,
is
Kamal,
the
just for clarity, this $5.7 trillion number that we're talking about is an annual gap that you're referring to, correct?
it is basically the finance that is needed now versus what is being provided by the industry. So it's not an annual. It's basically the finance needed and not available. Just to clarify.
So it's as of. Outstanding.
As of.
Outstanding. Okay.
That's right. And it keeps growing. The other enterprises in Pakistan is no exception to it. We have a large informal landscape as well. And the informal uh, gap, which is in addition to this, is $2.1 trillion. So you can see that, there's an additional 2.1 trillion that is sitting out there. And in particular, we also look at the women entrepreneur. The women entrepreneurs finance gap globally is $1.9 trillion. So what I'm trying to say is that while there have been a lot of efforts, globally on SME finance growth, but the gap continues to grow. And I think that's something, and I'm glad we're having this discussion today on what are the enablers to sort that out.
Okay. Excellent. Now, I want to talk about the Pakistan perspective, which mirrors that of emerging economies. Kamar, you've worked in Pakistan, so you would be familiar with the landscape. It's nothing to write home about. SME financing in Pakistan is extremely shallow. There's a number that goes around, but a census has not been done in recent times. The number of SMEs in Pakistan are around 4.5 to 5 million in number. Only about 170,000, which is 0.1 million, is being served by the banking sector. That's 0.1 million out of 5 million. And the trend in SME borrowers for the banking sector has been stagnant at 175,000, even when interest rates have been low. As per a study by Karandas in 2017, the financing gap stood at 3.2 trillion rupees, which in today's term comes to about 8 trillion rupees, which is about 8% of Pakistan's GDP, which is staggering. SME financing as a percentage of total financing has hovered between 5 to 6%, even in good times. But the NPLs and this is alarming, and this is a good scene setter as well. The NPLs have been around 14 to 15%. The problems facing SMEs are multifaceted, and most businesses in the small segment are informal, not registered with the authorities. They operate in a gray area and are unable to offer hard collateral that banks require. Now, they contribute the same to Pakistan's GDP, which is about 30%, and about 25 to 30% in exports. Now, this is how emerging economies look like where SME financing is concerned. This is how Pakistan looks like where SME financing is concerned. Now, having said all this, we now come to the topic of why do credit guarantee companies exist? Where do they come in? How do they address these lending bottlenecks and financing gaps? So I can quickly go over some of the points before I hand it over to our guests from Morocco who can walk us through their experience and their economy and their SME financing sector. So we believe that by providing guarantees, these companies on a borrower project or a portfolio level, they can absorb and share a risk with financial institutions, which are reluctant usually to lend to small and medium enterprises. We've seen that such institutions exist in Malaysia, Jordan, Egypt, Korea, and Morocco, and that SME lending has increased when the financial ecosystem is strengthened by these institutions. SMEs borrowers also benefit from lower loan pricing because de-risking is taking place, which flows from the guarantee itself. And these credit guarantee companies or instruments can help during economic downturn and are very important to counter cyclical policies when we go through a recession, which we well might in a coming few days, depending on the global events, of course. So now I'll bring in Abdul Momin at this point. So Abdul, from you, I want to understand what you think of SME financing in emerging economies. Do you disagree with anything I've put across? And what did Morocco's landscape look like? How did Tamilcom come about? And what are some of the bottlenecks it has been able to achieve in the past decade and a half?
Thank you, and good afternoon for your guests. About Morocco, we are not very different from similar emerging maybe economies, especially for some countries that are in the same region, because we have still some issues. For example, we still have important financing gap for SMEs. And this is due mainly to the predominance of informal sector. So according to the central bank, informal sector represents about 80% of the private sector employment and private sector entities. So which is still very very important. And also we have we don't have enough investment efforts by private sector, especially by MSMEs. So most of the investment effort in Morocco is carried out by either by the Moroccan government or state-owned companies or bigger private sector companies. The same applies for exports and or international development. We still have an important MSME gap, financing gap. So according to the figures of the IFC observatory, so it's represents about 18% of GDP, which is still very very important, and most of this is for micro companies and the informal sector. But regardless of that, we have seen some very positive developments, especially recently. Due to many reasons. So we have certainly the credit guarantee in Morocco, which exists since 1949. So we have more than 70 years of activity. Even if the shift to MSMEs didn't start before just from 2000 and onward. Prior to that, we were mainly for big companies, project finance and the infrastructures. But after that, we have shifted to SMEs, and more recently to MSMEs. Less than 5 years ago, we have started to cover micro companies. We have seen some steady development of our activity, and also in terms of the key key indicators for SME finance in Morocco. We have seen that, for example, the required collateral by the banks fell from 166% in 2013 to less than 70% currently, according to the World Bank Observatory. And also the growth of MSME's loans in terms of outstanding was 6% compared to 2% for the overall private sector, which is faster growth, which translated also to the increase of the part of MSME's loans compared to the total private sector loans. Now we have about 40%. The SMEs represent 40% compared to less than 25% more than 10 years ago, which is approximately just, very close to the OECD average. And also we have seen that trade guarantee outstanding compared to the GDP increased from 2% to currently about 10%. So we have
It's phenomenal.
some interesting developments, which is encouraging and pushes us to try to provide more to cover not only MSMEs but also startups using combinations of guarantees and other financial tools.
So it's been successful in terms of the number of SMEs financed, SME financing as a total of percentage of total private sector financing, SME as a percentage of GDP, and then of course there have been some relaxation in the collateral that was expected from SMEs prior to the credit guarantee prior to the establishment of the credit guarantee company. So is there more focus on a portfolio basis? Is it there's more focus on the borrower itself? What sort of approaches are you taking when it comes to guarantees?
Okay, so for our business or operating model, so we don't deal directly with the borrowers. So we operate with banks, with the leasing companies. So banks, we talk about both commercial and Islamic finance bank, leasing companies, microfinance institutions also. These are the main partners. And when we here this intermediaries, we cover the MSMEs. So we have two approaches. The first is the delegated approach, which is more like a portfolio. So the bank can approve the loan and also pre-approve the guarantee. So after that, they just send us the applications by computer and information exchange system, and we just check, for example, the ceiling per counterpart, and we check some, for example, if the applicant has some maybe negative history with us, for example, like some guarantee claims not cleared and so on. And after that, we grant our guarantee. So we don't, for the loans that are not exceeding $100,000 in terms of amount, we don't check, for example, the profitability, the solvency, and anything or any financial issue. It's just a computer-based check. For loans that are exceeding this amount, we receive this currency applications through our network of branches and via the banks. And after that, we analyze these applications, and after that we issue our guarantee. So this is mainly how we operate. And inside the products themselves, we have some incentives for some populations or some type of operations. For example, women-led or managed companies have higher guarantee coverage. Industry, exports, great economy also.
So we'll come to that later. Amar, I'd like to bring you in at this point. So I'll just make two quick points before I hand it over to you. Sovereign guarantees we've seen have usually been distortionary. And now in Pakistan's landscape, we have credit bureaus, we also have Infrazamin. So what what is the new thing that NCGC will bring to the table? It's obviously it's a very important addition to Pakistan's financial architecture. So what do you have in pipeline, and what will be its strategy where SME financing is concerned? We can come later to project and infrastructure later, but can you explain to us how it will solve this very shallow SME financing landscape that we have?
I think what's important to understand here is to really identify who really is an SME. You said 4.5, 5 million of SMEs. Who is an SME? Is a person who is cooking at home and selling food. Would they be considered an SME or not? Someone who is doing any kind of commercial service, for example, carpentry services or anything for a small business, will they be considered SME or not? Because if we broaden the definition, especially with the, I would say, gig work taking over in the last 5 to 7 years, the definition of SME has significantly broadened. So you said around 4.5 to 5 million SMEs. That's largely, I would say, on the basis of commercial electricity connections.
Yes, it's correct. Because the last census took place in 2005, and then there was this estimation done on the number of electric connections. You're absolutely right. And that estimate is also from 2018 and 19. Yeah.
Exactly. So the nature of work or the nature of small businesses has changed substantially. Now you got small businesses who are essentially doing cottage industry work or small work. That can be knitting, that can be clothes, that can be anything, that even makeup. That people make organic makeup and just small businesses and just selling them through e-commerce platforms. They're not even counted anywhere as an SME. They're not in any statistical database, but they actually exist. They have transactions, so on and so forth. So much so, the definition of an SME, even a bank, if they go to open a bank account, a bank will not open their account as a business. They will open their account as an individual because they're like, if you're a business, where are you registered? You really need to be registered as a business to be actually counted as a business. So I think what's important or what we're trying to do is basically broaden the scope of what an SME is really all about. Anything, any entity doing any commercial work that we will consider as an SME. Okay, now how do we do that? Over the last 5 to 7 years, one thing that has really happened is essentially there has been a surge in availability of technology platforms through which a lot of these, let's say, businesses are either registered or they sell through it. That's like a big database that no bank or any other entity has really tapped into. And this is what we really focus on. So what we're doing right now, we're talking to multiple, I would say, anchors, and we're essentially looking at some kind of a product-led growth where we create a lending product with a guarantee layer or a guarantee wrapper on top, and then we give that to the financial institution. So we're solving two problems here. One, the original problem that the credit guarantee is supposed to solve for is credit. Now, let's say you solve the problem for credit. As you said, sovereign guarantees actually distort but never really took off because you're solving the problem for credit, but you are not solving the problem for origination. My friends here would agree that the cost of originating an SME is much higher than anything else on a relative basis. So how do you solve that problem? You solve that by scale. This is what we're trying to do. We're trying to create products for the industry at large so that they are scalable. We start with small pilots and slowly and steadily scale them up rather than just saying, okay, you know what, this is a plain vanilla guarantee cover. Here, take it. Maybe it works, maybe it doesn't. So this is the, I would say, an alternate approach where if you're trying to figure with creating products with the help of the industry and trying to create something that can be packaged and that can be scaled up across different entities.
So you're saying the existing playbook needs to be rethought. The product suite available is not good enough, and then giving guarantees on that product suite will not cut it. New products will be needed, and then guarantees on top of those new products will serve the purpose of this finance to address this financing gap. If I understand correctly.
I'll give another small example, which all of us can agree to. We're all living in Muslim countries. There are seasonal demands. You've got Eid. When Ramzan comes, there is a seasonal spike in certain areas of the sectors of the economy. That can be for edible oil, that can be for clothes, so on and so forth. When children go to school, there is a certain surge in demand for books, stationery, so on and so forth. These are all SMEs which they need capital at that point in time. A bank either does not have the capacity or the will or even the incentive to structure products for them. But what we're trying to do is essentially identify these small areas, these segments where these SMEs operate, and structure products with these specifications, with the seasonal variations in mind, and then take it to the bank and say, hey, listen, this is a product, this is how the parameters work out, and you give the liquidity, we're even willing to take the risk on top. So when you start introducing these products, suddenly people or the financial institutions start thinking on those lines, and you can really scale it up that way. So this is really what really we're really pushing towards, more product-led growth, essentially.
Oh, okay. This is excellent.
If
Excellent. Kamar,
if I can come here.
absolutely.
I wanted to touch upon something Amar mentioned, and I think it's worth a consideration. On the non-traditional type of financing that SMEs are getting. So globally, we see 67% of the MSMEs globally use non-traditional financing sources. Now, I think, and let me tell you some statistics on some of the developed markets. Like in the US, in 2023, the digital lenders account for 45% of all the SME loans in the US, and it was up from 40% in 2020. When you look at UK, the alternate finance platforms are providing 40% of the SME lending in the pathway, which is around £7 billion. You look at Africa, I think Africa is also increasing. Nearly 20% increase in SME financing is happening through non-traditional lenders and fintech lenders. Look at China. Nearly 25% of the SME finance comes through non-financial sources. We have Artco, ZBank, many of them are members. So again, we are seeing non-traditional and fintech lenders, and in India also. And India followed a very interesting journey. When you talk to India colleagues, they say that digital inclusion leads to financial inclusion, then leads to economic. So the digital IDs and the digital infrastructure that was put into place really catalyzed a lot of SME finance in the country. So now the non-traditional lenders in India, in some ways, the market resonates in terms of similarity to cultural norms. So that's around 20%. So I just want to kind of build upon what Amar mentioned, that it's not just the banks. I think the fintech and non-traditional lenders have a big role to play.
I was just coming to this because my next bit was on technology. So either you or Amar can take this one, because in Pakistan, when we say technology, we just don't mean a fancy app. We mean how we can rethink ways of underwriting and appraisal, and how we are evaluating a customer that is underserved or unbanked. Amar, what do you have to say about this?
I think that's extremely important. When we say about technology, I would say technology, it's about ease of access more than anything else. More than fintech, I would say in the case of Pakistan, other in the developed economy, it's the pipelines, it's the tech infrastructure, the tech stack that actually exists. You can have the best fintech app in the world, and sadly this happened. But if that infrastructure, the ecosystem doesn't exist, it will fail to take off, because again, if a business goes to open a bank, I've personally held talk to these businesses. We used to run a book with 1 million SMEs, and I can tell you 99% of those SMEs and MSMEs were operating from individual accounts with limits of less than $100 a month. You cannot have a thriving SME or MSME ecosystem with such financial such services. So this is what needs to change as well. And again, this is, I think, what's important is having these conversations, putting these things forward, because our financial institutions, or a typical financial institution, is structured with large corporates in mind, because that's all they've been doing for the last many years or decades at this point. There needs to be a mindset change in how you cater to the large corporate and how you cater to thousands of small retailers, or thousands of small SMEs, or thousands of small light manufacturing entities. So that mindset change is what is needed. Or in the case of Pakistan, thousands of farmers at that point. How do you really do that? A lot of people have tried. A lot of agri-fintechs have come and have failed because the underlying ecosystem or the infrastructure doesn't exist. As Kamar said, what India did well was essentially create that digital ecosystem, and then everything thrived. Through just one presidential ordinance, everyone suddenly had a bank account. Here, it's impossible to get a bank account. If you go outside right now and try to get a bank account, no one will open a bank account till you give them 15 different documents. So that is a thing that these things need to be fixed in parallel before we can really say, okay, how are we solving the SME finance problem?
Okay, Abdul, I'd like to bring you in at this point. But with Tamilcom and its experience with technology, you've mentioned that you've worked and partnered with fintechs. But to what extent has technology been a core enabler or an instrument through which you've broken down these barriers or bottlenecks?
We still don't have really a strong ecosystem of fintechs, so we are not already working with fintechs in Morocco. So this the strategy of developing fintechs has recently becoming important for the Moroccan government and central bank, and they are just launched strategic study to enhance this ecosystem. And also, we are still, we have started to see the emergence of new fintech startups. But our experience with technology is more for using IT systems for assessing currency demands for the risk assessment also, because we are using some algorithms and the routine based on machine learning and some applications of AI. And also, the most important is the exchange of information and data between us and banks. So which can happen or throughout the day, and which allowed us to extend considerably our activity. So just for reference, we have our total staff is less than 200 people between the headquarters and the 10 branches. But we are able to handle currently more than about 50,000 operations per year, because more than 80% of those operations are carried out using the computer-based or IT-based information exchange system with banks, which spans from guarantee applications to the guarantee fee payment monitoring to the follow-on until the guarantee claim in case of default, and follow-on after the claim payment. So all this process has been digitalized, which allowed us to work with banks and data leasing companies, and more recently microfinance institutions. And it was very useful and valuable during the COVID crisis, because based on the same system, we were able to start immediately extending the COVID special guarantees with all the banks, because they already had mastered the protocol, and they know how to deal with us. And this allowed us to provide guarantees that represent the equivalent of 3 years of the general activity during the COVID crisis period. So now we are working to develop and enhance our information system, for example, to remove all email-based communications with banks, regardless of the size of the ticket, and also to provide them with more added value information, like, so, for example, dashboards that allows, for example, each bank to compare itself with other banks to check its own portfolio and so on, without the need of contacting our analysts or sending emails. So now this is a new development phase that we are carrying out for information system.
Okay. Great.
Another, Ali, if I can comment on the technology, is very important. It's very important, at least. And I just want to highlight that, what are the problems we try to solve? And SME finance, there are two big problems. One is the cost to originate and cost to serve. And the second is the risk, the perceived risk of the segment. So I'll give you an example of a member of a commercial bank in Bangladesh. SME business cost to income ratio of 60%. Just more manual, more, physical, possibly some digital infrastructure. Versus the bank in digital bank at present, cost to income ratio of SME finance of 15%, 1 5. So just imagine the kind of difference that you can creating. An NPL, despite having a 1,000 member team, Bangladesh around 18% versus an NPL of 2%. So all I'm trying to say is that these are the big problems technology is trying to solve for us. I think we need to, but I do want to cliche it a bit because it takes two to tango. It's not enough for banks to digitize and banks to have digital infrastructures. SMEs need to also digitize to the core. SMEs don't digitize their invoice. They don't digitize their payments. They don't digitize their own ecosystem. It becomes very hard to use AI and data and other engines that we have exist out there. So I do see, I mean, we're working with Monetary Authority of Singapore and UNDP on something called Universal Trusted Credentials. What it does is uses 60 alternate data points and creates a trust score for an SME that they can use, which is basically vetted by the regulator, which can be used for international trade. So imagine the power of an alternate data, because the day is gone that you look at financial statements and bank statements. You need to rely on technology.
So my view on this is, Pakistan, if compared to Morocco, is still is in its nascency. A customer, like Amar was saying, is more than the collateral that they have to offer. But if they create a borrowing history can be created, because they are borrowing anyway. If not from a formal financial institutions, they're borrowing informally, like we've seen in the agriculture sector. The RT is very prevalent. The informal money lender is very prevalent, and they are borrowing at very exorbitant rates. So, if a borrower profile can be created, and based on that, a credit score can be assigned. We now have two private credit bureaus operating in the country. A business becomes more than the hard collateral that it has to offer. So by having technology serve the right purpose, we can still make progress. I don't know whether you agree with this or not.
Oh, I think Pakistan, I mean, in particular, there are many data sources you already have now which can be leveraged. You have telco data, you have utility data, you have invoicing data, you have their ID data. There's so many different data sources that exist there. But we cannot be cannot be obsessed by the financial statements and really the financial records for company. I mean, the company is in US and many they're using social media data to do underwriting. We have Africa's some of the banks are using psychometric scores, not just for they're using psychometric behavior scores to underwrite. I just feel that obsession of getting 90% of the information right and then making a decision. I think we have to have more predictive modeling and really look at the leading indicators. If a customer's business is really dependent on one or two factors, look at those and then model on those rather than looking at the 95 different parameters that you have to look at. So I do feel that we need to demystify and subsegment the kind of data that we need to take.
Point well taken, but then even then, when financial institutions evolve in the way they underwrite and appraise, they still need the comfort of such companies or instruments such as credit guarantees. So they are very important, and I really liked how Amar explained that the existing product suite is inadequate, and that they will work with financial institutions to nudge them in the right direction. Maybe that kind of additional support is needed rather than just a plain vanilla guarantee. So now I'd like to talk about a second important role that credit guarantees play, and you can start by answering this before we ask Abdul to comment on Tamilcon's experience. Another important component is how these credit guarantee companies are able to crowd in private capital, which and then become a source of financial intermediation to attract investment. This is something I'd like to learn about or hear from you. How has de-risking taken place internationally? and how has it, led to crowding in of private capital?
Yeah, I think maybe I'll answer two parts. I think one is the credit guarantee companies themselves, and then who do the rest, de-risk instruments. So I think when you look at the landscape of the credit guarantee corporations, I mean, not all the countries have it. I think nearly 40% of the countries in the world have credit guarantee schemes. But there are 6, 7 kinds. There are public guarantee schemes, like SBA in the US and many others. We have private guarantee schemes, which are more like the Malaysia Credit Guarantee Corporation. Then we have mutual credit associations where SMEs collectively pool funds, which is an example like European Mutual Guarantee Societies. Then we have international monetary credit agencies like MIGA in IFC, the World Bank Group. We have coverage on sovereign as well. Then we also have sector specific. For example, in Africa, the agriculture credit guarantee scheme covers in Nigeria particular agri crop segments. And then we have regional credit guarantee schemes, which are African Guarantee Fund is another one which covers Pan Africa coverage. And then we have DFIs, and the DFIs is where I mean IFC and many other multilaterals have any de-risking instruments in place. So I think we do have funded risk sharing instruments and non-funded risk sharing instruments. And IFC has done several of these transactions where you're looking at particular segments, could be climate, could be gender, could be social impact. You could be looking at different areas, but there the blended finance comes in very important. You need to crowd in blended finance to allow for pricing points to be attractive for financial sector to go into the segments, especially the underserved segments. So I think the blended finance is a very important attribute when you're looking at the underserved segments. And the risk sharing instruments, we are about to launch one as IFC called Catalytical First Loss, which will look at, specific coverage for SMEs looking into agri, into women SMEs, and also looking at climate. So I think it's very important that you direct these funding, the de-risking instruments, towards the most underserved segments. Could be the very small enterprises, could be thematic, could be geographic, and that's where the blended finance comes in, very important. And of course, there are capital market instruments as well, bonds. I mean, we've done many social bonds, climate bonds, green bonds, so that you can also capitalize on the capital market instruments depending on the depth of the capital market in the country.
Okay, great. Abdul, would you like to comment on Tanwilcom's experience in crowding in private capital?
As for our case, so we are belonging to the Moroccan state, so represented by the Ministry of Finance, and fortunately for us, so the entire cost of risk is borne by the Ministry of Finance. So how do we operate? So we charge some guarantee fees, but they are not there to cover the expected loss. They are just there to cover the operating expenses. Also, the other the key funding source is from the Moroccan government. So how do we operate? Each year, based on our guaranteed production projections. For example, this year we are expecting to issue guarantees of about, for example, $4 billion. So this is the 2025 for the generation, based on the expected loss for each sub population. For example, SME establishment, SME development, working capital, and so on. We have some coefficients that enables us to calculate the expected loss over the entire life cycle each generation, and this amount, this expected loss, or this amount is requested from the Moroccan government upfront. So this year we will, for example, issue $4 billion of guarantees that we expect over the entire life cycle of this generation, that we will need to to pay the claims, for example, about, for example, for example, 100 or for 1 billion, for example. So we request this 1 billion from the Moroccan government, and it's paid by the Moroccan government. So this amount is received during this year, and we can invest it in bonds and so on to enhance income. And after that, this amount is depleted over time based on the current or effective loss rate. If we have some remaining amount after after the entire generation is over, we can reuse it for future generations. If the need is more than what we expected issues, so the American government is by the law obligated to cover all this cost. And also based on our law, so we don't distribute any dividends. So all the profit that we generate from our activity is resided into reserves and into special guarantee funds resources, because we don't work on our proper capital, but we have the capital or the equity, which is just one safety net, but the activity is funded using special guarantee programs that belong to our balance sheet, and that are directly funded by the Moroccan state.
Okay, excellent. Now I'd like to talk about another aspect, which is related to credit guarantees and de-risking. And I'd like Amar to take this one. So Amar, with guarantees comes the problem of moral hazard, and there becomes a tendency. I was looking at examples around the world, that there becomes a tendency for financial institutions to take additional and or unnecessary risk, or move their portfolio into on the risky side when they have the comfort of a credit guarantee. How do you plan to deal with this problem of moral hazard?
I think there will always be some moral hazard, the nature of the beast here. But what's more important here is to continuously iterate and redefine what we really need to do. The guarantee business, the risk business, it always works in permutation and constant iteration. If a pilot is working, great. If you see there's too much risk, figure out why there's too much risk. What are we missing? So you need to constantly update your assumptions and constantly iterate your product to avoid that moral hazard. I mean, if you just, let's say, create one product, I would say, let's say, a vanilla product, and it just goes on forever. So obviously, people will figure out ways to create that moral hazard. But if you keep on learning, if you keep on updating your priors and essentially your risk pricing at the same time, then the risk of moral hazard emerging where reduces. But that will always say, because this is literally what we're doing. We're trying to create that demonstration effect for credit guarantees, and there will be some moral hazard. How much and how less, it totally depends on how we update our priors.
Oh, okay. So you have to be proactive in the way you approach your partnerships with the financial institutions then. Because we've traditionally seen that given the fiscal deficits that we've been running, they've had very little incentive to lend to SMEs in the first place. Now, if they start lending to SMEs based on the fact that they have guarantees, then they'll be accustomed to those guarantees, and then they might revert to type when there is no guarantee.
So that is the thing, when do you need to stop? And that is what I always said my team and everyone we meet. We are focusing on underserved, unserved segment right now. Our target should be that a certain segment should graduate, and when it graduates, you move the guarantee to another segment. You cannot have, let's say, a perpetual influence, what we're doing in say of trade protection for a lifetime. There needs to be some kind of graduation that happens, and that is what is critical in terms of overall impact evaluation.
This excuse comment on this subject. So what we have seen in our case, so even if we don't have force the graduation process for SMEs in general, for example, for working capital guarantees, SMEs don't exceed 2 or 3 times in the credits renewal with our guarantees, and after that they can get credits without needing our guarantee. The same also, maybe we can see also for some very small companies when they get our guarantee to have, for example, the investment loans guaranteed by Tramwelcom. That we have seen that in the same time, because we can also check in the credit bureau, they were able to access to other financial services and other financing without needing other guarantees. So that means that also, because what happens is that in general banks can have some perceived risk prior to starting to work with SMEs, which we have experienced for our case before launching the very small and small guarantee program for SMEs for small tickets. Banks were reluctant to extend loans to this population, and they the perceived risk or expected loss issues or at inception was more than 10%, for example, when we started this program. After that, what happened is that the actual loss rate is less than 3% after all this more than a decade of activity, and the banks are starting now to compete on very small companies, and also they created some dedicated divisions just to handle the very small companies. So the moral hazard, if the banks are involved and the program is so well designed, will be could be really tedious and not should not play a key role for makers, especially for your case. For example, you are now starting a new guarantee company, so the politicians that that are maybe asked to support the system should not be very afraid of the risk of moral hazard of the over dependency of on the credit guarantee by banks or by SMEs.
If I can add a couple of points, Ali, just please release it first. Because I think the two things I want to mention, I think one is additionality. It is not about guaranteeing a bad book of a bank. I think it's about creating that additionality. And what are you trying to do? Are you trying institutions to go into new segments? Are you trying the institutions to go into certain thematic areas? So what are you trying to drive the behavior here? Because what you will set will drive the behavior of the institutions. So it has to be very targeted rather than, just, like Codit in Korea, they had a very specific focus on technology. And I think a lot of the guarantee and, the whole engine went behind that. And then they created another with Kodak. So I think so they felt, there needs to be a clear focus. So I think one is the additionality element that we have to consider. And the other thing that we sometimes forget is the process of getting a guarantee and the process of getting a claim. I think these can actually make or break a credit guarantee institutions. For example, Tramwelcom, I remember they launched the Man Express. It was a portfolio guarantee. Guarantee you can get online through submission, through electronic application. Instantly, you get the guarantee if it meets the criteria. And even the claim process was made very seamless. So if you don't have the guarantee origination process and the claim process sorted, you can have the best programs in the world, but they will not take off with the financial institution. So launching a guarantee is not the end in itself. I think getting it mobilized is where sometimes the rubber hits the road.
Excellent. Gentlemen, I had two more points, but I think we've run out of time. So, any final thoughts before I summarize and let you go?
Yeah, I think this was fairly extensive and a wonderful conversation. We pretty much covered everything and how, it's not just SME finance that we need to unlock, but a lot of other things in the ecosystem that need to work out in parallel to really get the impact that we're looking for.
So, this was a very, I hope, not a very dense, but a very engaging and enlightening discussion. We've learned that credit guarantee companies are a very important part of financial ecosystem that seeks to deepen itself and the capital markets at large. We've talked extensively about how shallow SME financing is in developing economies, despite the fact that they make the backbone of the economy in these countries. They are the backbone, but they're starved of financing, and this is because of various factors. They're underserved, they're unbanked, but financial intermediation that credit guarantee companies offer, the de-risking element, which can lead to a reduction in the pricing of the loans, which can provide comfort to financial institutions to step out from their comfort zone and lend to this underserved, neglected sector, is well documented. We've learned very interesting things from Abdul from Morocco, who has told us that SME financing as a percentage of GDP has gone up through the number of guarantees that they've given, both in value and volume, and how uh, technology has played a very important role in profiling of customers. Amar has is embarking on a very important journey whereby he's also working with financial institutions on a product suite which is more adequate rather than just giving plain vanilla credit guarantees. So, overall, how this credit guarantees approach the financial sector and how it works together with them is also very important. And just a vanilla approach won't probably work. CGCs, and apart from boosting SME financing in countries like the UK and Malaysia, they're also very important source of public-private partnerships that can lock large-scale funding for infrastructure projects and become a very important source of development impact, which can then again lead to increase in employment, clean energy, a reduction in carbon emissions. So sky is the limit if they are well placed and there is a willingness to work with the financial sector. So with that, I bid you adieu. Thank you.